All right, guys, welcome. We're just going to give a few minutes to join. But thank you so much for joining us today. We're going to start at around 5:05 West African time, just to give folks um, time to join. Thank you so much for making time. It's a pleasure doing this with you guys. I'm just letting folks in the waiting room. All right, I think we can get started. We can go ahead and let folks in as they trickle in. I can start with some introductions. Thank you so much, guys, for joining us today. My name is Josiah Adishagiri. I'm a co-founder at True Finance, and I am super stoked to be co-moderating this webinar series with my friend and buddy, and a very opinionated person, Mr. Chibby. This is the third of our sessions. We've had two sessions in the past. We have one tomorrow that will conclude the series for this quarter. It's been an interesting conversation so far. Folks have been super, super engaged. So feel free to write down your questions, use the chat box. If you want to say anything to me, if you have questions, just put it in there. What we're going to do, as we usually have done in the past, is give Chibi the floor for about 45 minutes or so, depending on how quickly he can get through his content. And then we're going to take some questions at the tail end of it. And yeah, without further ado, again, let everyone please maintain decorum. Everyone should be on mute. Please do not disrupt this session. And yeah, we'll definitely we'll switch it over to Chibi. Chibi is a seasoned, like I mentioned, super opinionated investor, very heavy on the things that he knows and knows them super well. So I'm pretty stoked to give him the floor. A little bit of his background. He worked at Barclays for 10 years. I mean, the grind. I know exactly how that could feel like. So he's bringing us a lot of content from, decades of experiences. And he's also been investing for over 16 years. So Chibi, without further ado, over to you. Take us away.
Okay. Can everybody hear me? Maybe thumbs up again. Okay. Right. So thank you, Desayo. Like she said, my name is Chibi. I've been investing for a while and I worked in investment banking. Now I'm sort of moving between countries. I run a concierge service, and really why I'm here is I do a little bit of personal finance mentoring for people. as you can see on the slide just there, we're looking at launching a little service called You Back You. So it's really about empowering people to do things themselves. From having a chat with this IO over time, I can see that, businesses like Trove and what they're doing in Nigeria really sits with what I'm trying to achieve, which is get people educated to the point where they can do things themselves, feel comfortable to act, to take action, take control of finances. So yeah, over time, we'll see how things develop. You can check out the website and just put your details in if you want to get any information from us when we start sending out material. Yeah. So, okay, back to our 20-year stock investment portfolio. Right. Next slide, Isaiah, please. Okay. So, this has given a bit of my background. I do personal investing. I do mentoring. It's always necessary to put in the disclaimer. So what I am not and what I do not do. So I am not a licensed personal finance, individual. I'm not an advisor. So I can't tell you what to do. I tend to educate, empower people, enlighten people. I tell people what I do in my scenarios and what I would do in certain other scenarios. But you really need to look at your situation and make decisions based on that. Now, a lot of the times, this disclaimer is called the small print. Like you're trying to get away with just hide it in there, and then you go ahead and give the advice that you're not supposed to give. But the last line there says why it matters. Two people could be, in very similar situations, and using a specific example like with finance, they have the same amount of money and they're listening to, a presentation like this, and they hear, oh, if I invest in Tesla stocks, it'll grow. And two of them, you don't have information on both of them. One can say, or one of them, for example, could be about to buy a house, and they could take their deposit or the money that they're going to use to buy a house and go put it in some stock, maybe not Tesla necessarily. And if that stock tanked tomorrow, let's just say they don't get to buy the house anymore. That's why it's important when people say, you should talk to a financial advisor, or the advice you get should be tailored to your specific situation. You need to know where you are with your finances to be able to make the best decisions. Yeah. But that said, I'll try to generalize as much as possible and give enough information to set you on the right path so that you can make those choices here. Okay. All right, next slide, please. Right, so a 20-year portfolio. Now, the first thing I'd say is the invitation said building a 20-year stock portfolio, but actually I'm going to move it away from people just thinking about stocks in terms of individual companies. So, a 20-year portfolio, the first thing to get in mind is that you're thinking long-term. It's not, the market moves up and down from time to time, and it can happen, if you look at the space of 1 year, like this year, it's been a bit of a roller coaster with the COVID-19 pandemic. But over 20 years, if you look at the market over 20 years, say if you go back to the year 2000, you've had the dot-com bubble, you've had the 2007, 2008 financial crisis that went into 2009, and you've had the COVID-19 pandemic. So what we're looking at is trying to build a portfolio that can survive three different, well, let's call them episodes, or major market dips, without you needing to act, watching the markets daily. Now, what's worth knowing is that beyond stocks, there are other instruments that you can use in building this long-term portfolio. You can have cash, you can have commodities, you can have bonds in there. And you can access all of these via very similar routes. So, if you wanted to buy US treasuries, You don't actually need to go direct to any other platform. Most brokers actually will provide it. So for example, in Nigeria, Trove have made it quite easy for you to be able to buy stocks, to buy funds, bonds, and commodities via that one single app. Which is, I said, I think things like this are amazing. I think it's the excuses that people had, or the reasons people had to not do these things in the past, are going away, and I think it's worth taking advantage of these opportunities that are now present. Now, when I say, without you look at a 20-year period without having to look at the markets daily, so that's the third point there, speaking about active or passive management. In reality, many of us are not finance professionals. We have day jobs, we have kids, we have things that's going on in our lives that mean that we don't necessarily have so much time to pay attention to the market. So, what's gold doing this week? What's gold doing next week? People have intense lives. And so personally, when I look at structuring a portfolio for the long term, I don't want to have to come and pay attention to what's happening day to day. So I'm more a passive management person. Active management would be where you're looking at things more often and making tweaks and changes. So you may need to make changes from time to time, but the less changes you need to make, it makes your investment a more passive one. Now, when you look at a portfolio over 20 years, the risk level will vary from person to person. So, and that would depend potentially on what you want that portfolio to do. So for example, if I put a pot of money together and I'm trying to grow that fund aggressively to start, say, to start a business in 20 years, or, that could be my goal. Somebody else could have the desire to get their kid. I will have a 20-year fund. I want my kid to be able to get a lump sum of money when they graduate at age 21. So, from the day your child is born, you're thinking, okay, they graduate at 21, I want to be able to give them some money. And then you have a lump sum that you put in for that purpose. You could also, say, be thinking about retirement. So, at whatever age you are now, you could be looking at how you would set up a portfolio that would take care of you when you no longer can work or want to work, depending on how you get there. So these are some things that you should be considering. Now, when people describe portfolios, it's normally termed as a portfolio. So they look at one person and they say, okay, your portfolio. But for this exercise, I like to think of portfolios as different things. So I look at them like folders. So in one portfolio, that portfolio for me, my long-term retirement portfolio, has in them assets in them, and it's serving a purpose. I have a portfolio for my kids. I've got two beautiful kids, a boy and a girl. I've got a portfolio for them, and I'm looking at, like I said, getting them to a point where when they graduate, I can leave something for them. And of course, you could have retirements as well. So I look at each of them as, take three different examples, three different portfolios for me. I don't look at my portfolio as one whole group. So, when I describe the 20-year portfolio now, maybe we should look at it in the context of one being my kids and retirement. Okay. Next slide, right. So when I'm looking at the long term, many of you who I've spoken to, those of you on here who I mentor, you will know that I'm not a fan of picking stocks. I say it in, any of the WhatsApp groups I'm in, I'm not really a fan of picking stocks. I think you can do it, but I go back to the amount of time you put into it. If you're a beginner and you are realistic about what you will do or how much time you can put into learning about stocks, then you can educate yourself and go about doing it. But the reality is that most people aren't putting the amount of time that you need. A lot of people are looking for tips. You going to different places and hearing things from different people, and not everybody is I guess, financially prudent to the point where they would say things like, I'm not a licensed financial advisor. There are people out there, if you go on the internet, there are people who will tell you, I'm pretty certain, you know, Nikola, and I hate to pick on them, for example, Nikola is the next Tesla. And people actually go put money in Nikola. And they may be right, they may be wrong, I don't know. But the idea is to be very careful when you're um, taking tips and picking stocks and putting in a portfolio, because you could lose a lot of money that way. Um, I have a preference for index trackers. So that first point. Um, there are not many individuals who can beat the stock market. So, right. So again, for the beginners on here, I'll explain what an index tracker is. The US has the S&P 500, which tracks the top 500 companies in the US. And there is an index that lists, how those companies are doing as a combination. Um, Sometimes it's used to reflect the state of the US economy. The UK, for example, has the FTSE. There's the FTSE 100, which tracks the performance of the top 100 UK companies. There is a FTSE 250, which tracks the top 250 UK companies. Now, that is a combination of all of the top companies rolled into one index. And what you have as a tracker or an ETF, so if you went onto any service on Google, whatever your broker is, and you did a search, you could search S&P 500, and you would find a tracker for that. One example, and is Vanguard. Vanguard have an S&P 500 tracker. The ticker for that is VOO, so Vulture Oscar Oscar. If you wanted to know that you're looking at the right thing, and that tracks the S&P 500. Now, to give you an idea of what individual stock picking is, so if I bought the tracker of the S&P 500, it means that I get an average of the gains of all of the companies and sort of a weighted average of all of the losses of of the companies as well. And so if one company out of the top 500 companies in the US totally goes bust, I don't really care, because there are 499 other companies that are still there and doing well. And so those companies will protect my portfolio basically from that one company that has gone bust. And it's possible for one of the top 500 companies in the US to go bust, just to add that. But if I went stock picking and I picked that one company because I thought it would do well, and I was wrong, it went bust, then I've totally lost money. And that's an example of why taking the time to do your research is important. But if you pick the tracker, you don't really need to do research at the same level. So you could then say, okay, well, I think the US is going to do well, and then you pick the S&P 500 tracker over that. Now, explaining so individual stock pickers, and this includes fund managers. But when I say individual stock picking, I mean maybe you as an individual going out there to pick stocks and put in a portfolio. There's stats out there that says even professional fund managers, only about 15% of them over the course of 30 years will outperform benchmark index like the S&P 500. So say out of every 100, only 15 of them will achieve this. And there's so many fund managers out there. And if you decide to pick the stocks yourself, you effectively become one of those fund managers. So what you need to ask yourself is, do you realistically think you are one of those 15% or not? I think to make your life easier, to make my life easier, I tend to just go with the trackers. So, ETFs, trackers over individual stocks. When it comes to mutual funds are professional fund managers managing the funds as well. Again, for the long term, I go with ETFs over fund managers. You can do the research yourself. In my experience, the information is out there. Very few of them, like I said, will actually beat the markets. And to understand this better, when you see a fund and you see that their performance right now, say a person or fund is outperforming the market by 200%, there is a concept called the reversion to the mean. So if you outperform the markets by 200% in 1 year, and over time, the stats say most people will underperform the market. So if you're 200%, above market, what it means is that at some point, you're going to underperform the market by 200% as well, just to be able to come back to the average level that the tracker has been doing. And so for me, I'm very careful when, personally, I'm very careful when you see these funds and they have stats that show 100% over performance and 300%. That's because you know that there is a potential that there will be some down period where again, they revert to the mean. And so one thing you need to be careful of is whether you're looking at a short-term period, and that's fine. If you want to go into a fund for 1 year, 2 years, and you think that's going to be a great year, you're okay to make that choice. But over the long term, there are very few funds that exist that have stats that go 15, 20 years long. There were amazing fund managers in 2009, 2007 to 2009, when there was the financial crisis all over the world. They bet correctly in those periods and they were superstars. But many of those names, 12 years later, are no longer there. And so if you had, picked one of those guys, for example, in that outperformance, you might not be doing so well just now. And so there's information out there on how even the best fund managers do compared to the market. And people like Ray Dalio, for example, who's quite a big name, one of his best, his best portfolios, it's called the all-weather portfolio. And if you look at that portfolio, it really only returns somewhere between 7 and 9%, which is about at par with what the S&P 500 has been doing. So a top manager like that, where he has he runs a hedge fund, it'll cost you $100 million to be able to get in, is basically achieving 7%, or 7 to 9%, so under 10%. But the idea is that he is doing that consistently. People like Warren Buffett, they do these things consistently over time. And even Warren Buffett advises people to just stick with trackers, so index trackers. And so
I think we lost you there.
We lost him.
Chibby, I think you went on mute. Let's just give him a couple minutes. He might need to rejoin. Oh, there you go.
okay.
Awesome.
All right. Do you have me back? Okay, yeah. Right, so apologies for that. I seem to have got a dodgy connection just there. So I was saying, yeah, Warren Buffett, well, depending on how you see him, the great Warren Buffett, investing for a long time Warren Buffett, not super keen on Bitcoin Warren Buffett, says people should stick with index trackers. Right, so hopefully you get the idea from that. And one more, when you look at trackers, one of the things that you want to be looking at is the cost. So, you could have a company, you could have a fund manager who is tracking the S&P 500 using that example. And you could have another company that actually just uses computers to track the same index. And the expense ratio will show you the cost of tracking. And so I tend to go for a lower cost tracker Now, Vanguard, I mentioned earlier, are an example of a really, really low cost tracker. So they have an expense ratio of about 0.04%. That's, again, so on $100, you would be paying 4 cents. And so that's a really cheap way to just track the S&P 500. So you need to be looking at things like expense ratios. When you're looking at your trackers as well, if you go to the next slide. Okay, so yeah, you want to look at reputation. So what is the company that's offering the tracker? Vanguard, pretty popular. You want to pick your exposure. So your exposure, that's whether, okay, am I tracking the S&P 500? Is that the index? Do I want to track the NASDAQ? Do I want to track the FTSE, which will give you exposure to UK companies? The S&P 500 will give you exposure to, the US companies. You can have global indices as well via Vanguard. So you can have exposure to all, like the stock model, a combination or a representation of all of the stock markets. So with global indices, you could have Asia specific, China specific trackers as well. So it's good to just take your time and have a look, pick what exposure you want. When you're looking at ETFs, you can go down to a specific level. So you can say, okay, I think, electric vehicles are going to be a big thing. You could look for trackers that actually track EV companies, So there's, you can have trackers for commodities. So I was saying earlier, there are commodities that, like gold, instead of actually buying gold itself, you could buy an ETF that tracks the price of gold. And that would be a fairly cheap way of getting gold into your portfolio without you having to think about storage. Similar to treasuries, I was saying, if you look through your broker or your whatever platform you use to invest, you could look for treasury items, so trackers for US treasuries. And for all of these, like I was saying, you can look at the expense ratios to see what charge you would be paying. The lower the charge and how accurate the tracker actually is with the index. So what you want is a tracker that really follows the index pretty closely. If you have a product that is called an index tracker and it's, over long periods outperforming the index, it may feel good, but that's not a great tracker. Because if you consider it, even though it's outperforming the index right now, it just means it's not doing what it's supposed to do, because it could then, like I said, revert to the mean by having a period of lower performance. So you want a tracker that would very closely track the index that you want. Now, if you were going to go beyond trackers, you need to look at things like the risk profile. So when you look at what exposure, so if you're looking at a tracker for treasuries, US treasuries are seen to be pretty safe, one of the safest in the world. That would have a pretty low risk level. If you had a tracker that was following an emerging market, that would be considered higher risk. So things like stable governments, but sometimes higher risk provides higher rewards. It's really, again, down to you and deciding what you want to track. And then, of course, you look at return levels. So what are the returns on these trackers? Bonds being safer will give you lower returns. Tracking the S&P 500 will give you decent returns. If you went into a smaller set, like I mentioned, if you're looking at tech companies, if you were looking at EV companies, so electric vehicles, those will actually, at this point, look like they're giving much higher returns. And what that performance is over the long term, you get to take a look at that. And one thing, again, that is always worth reminding people is that how a tracker or a company has performed in the past does not guarantee how they will perform in the future. But this line being my own personal opinion, I think it'll give you a general idea, but you do need to look at other factors. So for example, 20 years ago, China was not exactly where they are now. They've actually become a very big player in the world. Um, if you look at the growth companies or the tech companies that we look at today, so if you think about Facebook, um, that actually went public after 2000. So if you were making this decision 20 years ago, Facebook would not have been an option. Google would not have been an option. Tesla would not have been an option. And so even if you were a great stock picker in the year 2000, you probably wouldn't have, and you didn't continue to revise your picks, you may not have great companies like Google, for example, or Facebook in your portfolio. However, if you had picked the S&P 500 20 years ago, um, they would still, as the S&P, as the companies become larger and more prominent, they actually make it onto the S&P 500, and that way you automatically inherit great companies over time without you needing to pay attention to any of that. Um, and that's the other thing about it being more passive. If you pick the S&P 500 to track over 20 years, you don't really need to know much about tech companies. You don't really need to know much about um, electric vehicles. You don't need to know much about utilities. You kind of just know all of the best companies will show up. Excuse me. Um, okay, next slide. Right. Um, okay, so I just going back to stress the point about why I personally like to go with index funds. So, the first point there, the average fund is outperforms fund managers by 2% over the long term. Um, like I mentioned earlier, only 15% of fund managers will beat the market. And, that includes the professionals that we think about. And that includes Warren Buffett and Ray Dalio, to be honest. Maybe they're among that 15%. Um, and to consider the effect of that, right? So if a fund outperforms, like if a tracker outperforms a fund manager by 1.5% over the course of 20 years, you will get a 24% increase on your investment if you went with the tracker. um, and so, over time, that little 1%, 1.5% difference adds up. It's the other reason why you need to pay attention to the fees that you pay. One of the things about people, one of the things to bear in mind when people are picking stocks, you pick a stock today, you pay a transaction fee when you buy those stocks. You decide you no longer want it, you sell the stock as well. Um, the cost of buying and selling actually has an impact on your overall portfolio over time. So that's something that people need to bear in mind. Um, being able to make a decision, so you buy your investments, you're looking at it at the long term, for the long term, and not needing to buy and sell reduces the fees that you pay. And so if you're able to reduce your costs, so even if you don't have a fund manager, if you're tweaking your portfolio too often, you are actually affecting your long-term returns. So that's something to bear in mind. And that's why picking lower cost investments serve better over the long term. 25% is a big deal for me, over 20 years. And so, yeah, that's something to consider. Is our next slide? Okay, so now after all of that, go into the piece which is actually setting up the portfolio. So, and it's almost a summary as well. So you decide the purpose of your portfolio. Is this my retirement? Is it my kids? What Then you go into what exposure you want. So do I want healthcare in the US, the US stock market? Do I think 5G is going to be the big thing? Am I looking at commodities, gold? And it doesn't have to be, it can be a combination of these things. You can have, global stocks. You could have a portion of gold. If you went online and looked at the all-weather portfolio I described, um, that has what is it, a 40% allocation for U.S. Treasuries, about 7.5% in gold, 7.5% in other commodities, and then about 30% in stocks. Now, whether you want, that 30%, you can have it be US stocks, so just pick the S&P 500. Um, and you can do all of these as trackers. You can have a tracker for the S&P 500. Vanguard, if you want, all of the US markets, Vanguard will provide, Vanguard have a tracker that actually does that. If you want global stocks, that's possible. If you want to include just a portion of global stocks and have a majority in US stocks, that's possible. Um, you could actually just decide that your 20-year strategy is to, what is it, just pick the S&P 500. Like I said, depending on how aggressive you want to be, you could have just the S&P 500 over 20 years. If you did that 20 years ago, you would have done pretty well. From the beginning of time, the stock markets have pretty much, well, since 1920, since records started being kept, the stock markets have outperformed just about any other asset class. So it's considered pretty decent pick if you don't want to give yourself um, too much of a headache, with picking these things. Um, Also thinking about the stock markets, if you look at things like, I'm putting this from a global perspective. Whether you live in Nigeria, depending on how volatile things are, if you had investments in the U.S. stock markets, that would actually preserve a lot of value. So the inflation, the depreciation of the naira, those things you're insulated from if you were picking these stocks. Again, I will point out that businesses like Trove that have made it possible for you to literally deposit money from your account and get these assets, um, it's a wonderful thing. So, house prices may be great in Nigeria, but they may not be so great in the UK, or they may be great in the US. And regardless of where you are, you can pick what exposure you want, using trackers anywhere in the world. So I think whatever broker you use, you should investigate some of these things and make a decision. Now, so yeah, after you've decided what assets you want to put in, so you can have mutual funds, stocks, ETFs. You know what my preference is. The thing you have to do is actually act. You have to take the step. A lot of people spend time reading, thinking, but you can take that step. Now, when you do this, one of the things I also advise is I don't time the markets on a long-term portfolio. So, people say things like, "Oh, there's always a crash coming." And when you're in a crash, as soon as you get out of that one, there's the next crash is on the way. So I'm not really bothered about trying to wait for the market to be low so that I buy low. Um, if you put together a good strategy and you're looking in the long term, um, you don't need to be timing the market. So today, and before the coronavirus crisis, like, you can see the U.S. markets have recovered pretty much to where they were before coronavirus started. Whether or not, there's talk about another crash coming on. Whether or not that crash comes, I personally don't think there is a need to wait for a crash to get in. So I think now is as good a time as any other. As long as you continue to stick to your long-term plans. I know it can be quite intimidating or daunting when you've just gotten into the market and you see it dipping. Um, there's a concept called averaging down, where as you if you buy consistently, so, say the markets are at, I guess, 500, let's call that a level, they drop to 400. If your investment strategy is to put in money consistently, so you have a portion of your income, say, whatever that amount is, and you put it in consistently monthly over this 20-year period, because it's a long-term portfolio. That's what I do for my kids. I have an amount that I pay into their accounts monthly, their investment accounts, and I'm not paying attention to what's going on in the market. So I'm just putting that monthly payment in. If I buy when it's high, that's okay. If the markets crash and I continue putting in the payments, I will also be buying when it's low. So I don't feel a need to wait. Even if I was going to do it at one point in the year, to be honest, I'd be focused on consistency rather than timing. Is the thing. And looking at discipline, the discipline to continue to invest even while the markets are falling. So people want to wait to time the bottom of the markets, and then you're waiting, you don't invest in one particular month, and the market goes the wrong way. There's there's some well, again, stats or research that shows while the S&P 500 on average has returned, I think it's about 9.6%. If you were timing the market and you were not actually invested on the top days, with something like the top 9 days of market performance, that 9.6% return for you could actually drop to levels of about 5 to 6%. And so that's that thing where you're trying to wait till it's at its lowest and the market goes the other way, or there's a spike in the market. You could miss out on those benefits. So I don't try to time the market, I just act. Now, the final point there, which is react. So if you've picked one single asset, which is the S&P 500, I just continue to, consistently put in your payments and watch what happens with your portfolio over time, knowing that markets can go up and down. But if you look at the long-term charts for the S&P 500 and many stock markets around the world, they are generally trending upwards. And so hopefully they continue to trend in that direction and your 20-year portfolio continues to go that way. But what I mean here in terms of reacting, if you put together a portfolio, for example, I looked at the all-weather, I mentioned the all-weather portfolio as an example, or let's just say, okay, bond and stock portfolio. If I'm coming close to retirement and I have, say, 40, 50%, 60% of my investments in bonds and 40 or 30% in stocks, if I were doing this over 20 years, if the markets had a really good year and bonds didn't do so well, if the size of my stock investment doubled and the bond investments halved, for example, you could then have a scenario where you are no longer, say, in a 60-40, 70-30 scenario. So if you look at it and say you wanted your portfolio to be 70% bonds and 30% stocks, but now because of how the stock markets have performed, you actually have, say, 60% stocks and 40% bonds. There is a process called rebalancing where when you do your next set of investment, so instead of selling things, you could just then change the way you invest. So since you have higher stocks than you wanted to, the next set of investments you make, you can actually just skew them towards the bonds until you get that balance to be the right way. So, if you were investing $100 a month and you were putting 60% into stocks, or 70% into, 70% into bonds and 30% into stocks, then you could now start putting 100% into bonds until you look at that portfolio and you have that 70-30 balance that you were going for. So that's what rebalancing is. Again, you don't need to do it very often. You can take your pick of how often you want to do it. Personally, I do that once a year because I review my finances once a year. I just take a look at what it's doing. But during this year, I'm in a number of groups, and you guys that I talk to know this. When there's a lot of action and reaction of gold is going here and there, for my long-term portfolios, I'm not really doing anything. I have other portfolios that I'm a bit more aggressive with that are shorter term. But for the long-term portfolios, I'm not changing anything during the crisis that comes. So, this crash, the next crash, the crash after that, I have a portfolio that's I'm comfortable with. It has a global exposure, and I just keep, investing consistently. Yeah, that's about it. Just about 13 minutes for questions. Next slide is the one that says questions, I believe. Yes. Happy to take questions.
Awesome. Thank you so much, Chibby. We do have a couple of questions here. Guys, if you have questions for Chibby, please go ahead and use the chat box. I will be reading out every single question. Chibby, that was very insightful. Thank you for sharing your expertise. I can start by taking the first question. Okay. So in your personal experience, are there any particular indices that have performed well historically that you would recommend?
So again, you do need to look at your personal situations. I have mentioned the S&P 500, and I would say if you didn't know where to start, I'd say take a look at the S&P 500. Look at how that index has performed over time. Look at the direction it has trended. Look at what it did in the pandemic this year. Look at what happened to it in the crisis, the financial crisis of 2007. Look at how it did in, the dot-com bubble of 2000. And hell, look at how it did in the Great Depression of about 1929. I think, there are records that far back. So take a look at that and see how you feel about it. And then, yeah, from there, do some more research and see. But that might be a good place to start.
You're not going to give any recommendations, Chibby?
Recommendations, no. But if I were doing this for the first time myself, I'd take a look at the S&P 500. I would go for a low-cost one like Vanguard. So I just, go into my broker my Trove app, search for assets, look for trackers, or type Vanguard or VOO in there, see what comes up, see how that has performed over time. I think that's what I'd do. But, you need to think about what you would do in your own situations.
Fair enough. Fair enough. Thanks, Chibi. The next question says, please, what index fund tracks 5G stocks?
Okay. So couldn't give you a name off the top of my head, but if you Googled 5G index or 5G ETFs, right, you would see quite a number that come up. And then, if you go back to what I said about, you would see quite a few, but there are some things you want to consider, like how, what size is the fund, how well has the fund done over time. But if you literally, I think there's a website called etfs.com. If you literally just Googled 5G ETFs, the numbers would come up. Again, I think I try to keep this stuff as basic as possible. I think the information out there is quite like, it's present. Sometimes it might just be knowing what to look for. And I think quite simply 5G ETFs will get you a few names. Then you need to look at the reputation of the company that is actually providing that ETF. So if you found, for example, iShares, Vanguard type of name, SPDR, those, in my mind, are companies that I use, and I think I'm pretty confident about how they performed in terms of their ability to be here in 20 years.
Awesome. The next question says, does Trove platform enable investments into Vanguard and Fidelity investment indices, ETFs, and all of that? Okay, so I think this person is saying, do we, as Trove, let folks invest in ETFs? Absolutely. You can just go on either your web platform or your app, and navigate to all assets, and then you can navigate to ETFs, and it should have a wide spread of things. And for every single asset, you can actually start with your research on the app, or on the webpage. There are things like institutional investors that that either use the ETF or things like that, or just like things like earnings or similar ETFs and stuff like that. So definitely check out the app or check out the web. And then the next question for Chibby is thoughts on ARK Invest and their ETFs.
Okay, so let me do that one real quick. So I'll just tell you guys what I'm doing right now. I'm literally doing what I said. I'm gonna jump on Yahoo Finance. I have a pretty good service where you can, if you find an ETF, you can go on there and see how they perform. Yahoo, quite a popular website. Right. Now, I believe I've looked at ARK in the past. I think they're pretty good. My thing with ARK was, if it's what I recall, the expense ratio, just compared to the industry average, I thought was a little bit high when I looked at it. I'm saying this off of memory as I wait for the page to load. I'm gonna look now. Yes, so expense ratio of 0.75%. So I think the returns are good, but with an expense ratio of 0.75%, I give you an example with, so about the average with expense ratios tends to be about 0.4. If you start approaching 0.2, you're on the lower end. If you approach 1.5, remember what I said about, if a tracker is beating a fund manager by 1.5%, look at what that does over time. And fees could be the same thing. So if you looked at what you want exposure to, if you're happy with the returns, then the expense ratio, you can just subtract the expense ratio from what the returns are. So if it's going to cost you 1% every year and the tracker you're looking at is returning 30, 40, 50% a year, then less that 1%, you're still doing pretty well. So, don't be too concerned about that. But if you say have any reservations around, well, whether the levels that you're seeing are sustainable, which is why you need to look at how long this performance has been. So if they have, if a if a fund is having a good year, and it's returning 100%, and it's only done that for the last 2 years, then you got to really think about whether that is sustainable and what you would do in that scenario. So yeah, where there may be, other trackers that do the same things, and this might be some exciting research for people to do. It's exciting for me. So if you see what ARK is doing, for example, and the returns they're having, you may want to look at if there are any other providers who can who track the same things, but have a lower expense ratio, because that'll mean more money for you over time.
Okay. Thank you, Chibby. The next question says, what is the key difference between income and accumulation funds on Vanguard?
Okay. So income funds versus accumulation funds. So income, when you go through the year and your fund, returns that 8, 7, 10, 100%, whatever that number is, income funds are designed to pay you an income. So the returns are, you can actually have the interest paid out to you. So you could have that 8% return. So if you had $100,000 or $1,000 and 8% came out, those $80 will be paid to you. Rather with an accumulation fund, you could then the the returns are automatically reinvested into the fund. And so this is where compounding comes in. So if you think about it, if you had $100,000 and every year it paid you 8%, if you took out that 8% every year, you would receive 8% and your $100,000 would be $100,000 forever. And you have a nice 8% income coming in. If that's what you want to do, that's okay. With accumulation funds, the 8% would go in there, and that 8% from year one would then accrue a further 8% in the second year, which will mean that the returns you get over time from accumulation funds grow more than income funds because of that reinvestment. On that note, personally, just something, what I like to, rather than having the income come out to you, because depending on what country you live in, when these monies come out to you, you need to consider your tax liability, because whether it's treated as income or not, depending on where you are, it's something to consider. I personally like to look at accumulation funds because where that 8% is reinvested, you then have the option. So, if you have $100,000 and you accrue 8%, you have the option of choosing whether you want to pay yourself 1%, 2%, 3%, 4%, 5%, 6%, 8%, you can choose what you want. And so if you find you are close to a tax threshold and you want to stay under, maybe this year you want to take only 1% rather than the full 8%. So accumulation funds, for me personally, I like the flexibility where I can choose what I take out and I get that accrual. But say if you are retired, for example, and you're happy for the $100,000 to just sit there and you want that 80, the income to get paid to you so it hits your bank account and you can do other things with it, then there's a scenario for that. So again, you need to think about, now you know what both of them do, you need to look at your personal situation and which one you would prefer.
That makes sense. So the last question we have here is, if I want to get exposure to more emerging markets, India, China, Africa, do you think that the S&P 500 is the best, or do you have any other recommendations?
Right. So exposure to Africa. So S&P 500, to be honest, would not necessarily give you exposure to Africa. You may inherit some exposure to Africa. So if you think about some companies on the S&P 500 that have invested in Africa, but what amount of that, the African business and how that influences the parent company based in the US, that would be relatively small. If you wanted larger exposure to Africa, again, you could then just Google African ETFs or country-specific ETFs and see what comes up. I know there are a few businesses out there that actually look at how they can make it easier for people to get access to some of the markets that are not the local markets. So again, you can check with your broker what's available. So not every broker would have every asset, but if you see an ETF that you want, you can check if it's available with your broker or how you can get access to it. And then you can track it down that way. Kind of trying to keep the process high level, because I know there are a number of people from different parts of the world here. So, wouldn't want to give a UK specific answer or a US specific answer, an answer specific to Nigeria. So yeah, find the tracker, I'd say would be the first step, and then check whether your broker has it or has one similar to it, and then go from there.
Awesome. And yeah, if you have any specific ETF that you want listed but is not on the Trove platform, you can just email us at hello@troveapp.co, and we can look to listing that just to corroborate what Chibby said. But thank you so much, Chibby. Those are all the questions we had today. We really enjoyed the session. Thank you guys so much for engaging and for asking Chibby questions. Like I mentioned earlier, this is a recorded session. So it would be on YouTube shortly after this conversation. So feel free to follow us on YouTube. It's True Finance, that is the handle. And feel free to also follow us on social media at True Finance. Again, if you have any questions specifically around Trove, if you're going through the KYC process, which is just the know your customer process, or you want to have any conversations around downloading the app, or even if you're in several different countries and you just want to kind of understand how you can use Trove, please feel free to email us at hello@troveapp.co. Follow us on social media, slide in our DMs. We're here for all of that. Thank you so much, Chibby, for sharing your knowledge. I'm sure we'll definitely will have you back over the next few months. And I just volunteered again.
Yes, no, I'd be happy to. And like I said, I think it's excellent to have the opportunity. I thank you, and I think what you guys are doing is great. And maybe just to add, if there were any specific questions for me, apart from Desire knowing how to reach me, and if you can actually go to www.ubacku.com. If you signed up, if you just dropped your email address in there, I would actually send out an email and everybody would get my contact details, my email address. And then, we can actually start having conversations. Some of you I already have in separate groups and I have mentoring sessions with. But yeah, so there's ways to reach me, and I'd be happy to continue conversations. I'm really passionate about, again, just enlightening, educating, and getting people to invest safely. I think that safe part of it is pretty big for me. Just not losing money and not doing very dangerous things with long-term funds. Yeah. So thanks again, Desayo.
Of course. By the way, some of them want the slides. Is it okay to share the slides?
Oh yes, sure.
Okay, fantastic. So for me, we'll
discuss any of the points further if needed.
Awesome. Thank you so much, Chibby. Guys, we've come to the end of today's session. Do not forget, we have one more tomorrow with Christina Patrizio. She's an ex-Goldman analyst, and she'll be talking about stock investing made simple. We have sent out communications via emails. We'll also put it on social media. So if you want to join tomorrow's, feel free to slide in our DMs. We'll send you the link to join. And yeah, thank you so much. We'll drop the mic now. Bye, guys.
All right. Thank you.